Welcome everyone to the Building Strong Financial Projections workshop hosted by the Frenchtown Neighborhood Improvement Association as part of the Tallahassee Farmers Promotion Program. So I'm so excited you're here and hoping that through this presentation, you're able to gain some tips and strategies on how to build financial projections for your aspiring or current business. My name is Christina Lynch, and I have a background in accounting, finance, and HR management. I have been working in accounting and HR for about 14 years, with 9 of those years with having experience in consulting for small businesses and entrepreneurs. So in addition to my role as CEO for Trident Consulting, I'm also a contract consultant with the Small Business Development Center at Florida A&M University and the Business Empowerment Director for the Capital City Chamber of Commerce. So today we're going to dive right in with how to build those strong financial projections. So the first thing we want to really ask ourselves is, how is our business going to make money? We typically have some type of product or service that we're going to sell, but what are you actually doing to earn it, and how are you going to actually make that money? What does your business need to get off the ground or to that next level? And then what is your operating budget? These are all things that we want to keep in mind when trying to build those strong financial projections, simply because in order for us to say we're going to make $50,000, what is included for us, what efforts are included, what expenses, and what time is required for us to actually accomplish that goal. So when we're developing a financial plan, there are some things that we may want to consider. One, creating a strategic plan. That is because our strategy is going to tell us what are our goals in the next 3 to 5 years, and then what are we going to really work towards in that time frame. So if we're trying to earn money, who are we reaching out to? What is our strategy for providing that product or service to our target market? And then what does that look like? We can also consider creating financial projections and a budget, so we know how much are we expecting to earn in what time period, and then what are the expenses associated with those earnings. We want to plan for contingencies. So being able to think of, like, what if something happens? What is our plan B and our plan C? Because we typically know things don't just happen on their own, but there's typically some type of interruption. So considering what those contingencies are ahead of time, and then monitoring and comparing our goals. So we set our goals. So with the projections, those are typically our financial goals. But then at what point and frequency are we checking to see, are we making those goals? And where are we compared to where did we think we were going to be? So in developing our financial plan, the projections is really one component of that, with the overall goal of having a plan of action that is attainable, realistic, as well as a specific time frame, so we know what we're going to do, when we're going to do it, and then holding ourselves accountable to that. So what are financial projections? I've said it about 4 or 5 times now, and for those of you that aren't sure, it's a forecast of future revenue and expenses. So we are projecting into the future what we think we can earn, what we think we can actually accomplish, and that's going to help. Our projections are typically made from internal or historical data, or if you're new and you're starting off and you're like, I don't have any historical data to go off of, it's a prediction of external market factors. So what factors exist and that are going to affect what you can earn. And so a great example of that is, for instance, I provide tax services. So when I'm considering what are my earnings going to be for 2024, I know that one external factor there are hard deadlines for when tax filings are due. So the IRS says that taxes are due typically around April 15th every year. So with that, there's an influx of individuals, which is the majority of the country, are looking at filing their taxes between the end of January and the middle of April. So I can account for, and I can predict that I'm going to have an influx of business between the end of January through mid-April. But then I also know that there's a certain part of the population that's going to file an extension and say, I would rather wait till October 15th. So then with that, I can say, okay, so there's going to be a set of individuals that would prefer to wait. So I may have some business between April 16th and October 15th, but it may not be as large. So I can look at these external factors of regulations that exist. If there's an increase in audits, or if, let's say, there's some type of new information that's coming out from outside parties, and use that information in my business to be able to project how much I think I can earn and what part of the year, or what time of the year, and then how much does it cost for me to actually offer that service. So thinking of what your business is, what external market factors exist that are going to affect you and what you offer. And that could be competitors, it could be regulations, it could be socioeconomic factors. So what things exist in the world that could affect you in your business? Then we want to know, how can we create those projections? So that part, we're just quantifying your business story. So I always tell clients starting off, if you're unsure of what direction to go in, close your eyes and what do you see? So when you see this business that you're beginning, or this business that you're trying to sustain or grow, what do you see? What does the business environment look like for you? Does it require you to have a business vehicle? Does it require you to have a larger office space? Do you see employees in that vision? Are there certain technologies needs that are required? So everything that you see is quantifiable. So we're really just taking this visual and then seeing, how much does it cost for us to operate with all of these things that I have in my vision? And then how many people am I trying to support? Where do those people live? And then what's the typical market price for that activity, or what are you charging for that? So creating projections is simply quantifying your business's story. So we really don't want to make it any more complicated than that, because we want to make sure that you're able to actually continue to offer the great service that you have, or begin that process. So one thing that we want to consider, as I mentioned, we're quantifying our business's story. So we want to make sure that we can affirm our goals through these quantifying practices. So that means we want to create what they call SMART goals. So specific, measurable, achievable, relevant, and time-bound. So if I go back to this, so let's create a new example. So let's say our goal for 2024 is that we want to begin to grow flowers. So let's say typically this is an agricultural business who's normally farmed and harvested vegetables and fruit. And now it's like, you know what? Flowers, one, they're pretty. We know that a lot of flowers are pollinators, so it can assist in bringing the right environment to your farm or to your land. But we know that there's a high value for flowers to certain households, and they are willing to pay a premium for organic flowers, for fresh flowers. It's a great value added product if you're selling direct to consumer at farmers market. So there's a lot of great reasons, and there's a high profit margin. So let's say there's a lot of great reasons for having flowers to be as a value added item when you're at the market. So instead of saying, I want to grow flowers in the future, that's not really what they would consider based on these parameters to be a SMART goal. In order to convert that, we may say, I want to grow 3 types of flowers in 2024. Then 2024, we know it's specific. It could be more specific because we could say what kind of flowers. We know it's measurable because we're saying we want to grow 3 types of flowers. It's achievable because we've already decided that we have this. We could say, okay, we know we have the space and we're going to start with 3 versus saying we're going to grow 100 different types of flowers in our farm in the next year. It's relevant because we know it's a value added product related to our business model of growing natural items or food related items for sale. And then it's time bound because the goal is to do it in 2024. So instead of saying I'm going to grow flowers in the future, and that may be a goal that gets backburnered or kicked down the road, by us now creating this SMART goal, we can hold ourselves accountable and be able to measure whether or not we were able to succeed our goal, meet our goal or surpass our goal. So that is an example of how we make something quantifiable. We now have this goal that we are going to grow 3 types of flowers in 2024. If we wanted to, we can now take that a step further, because if we can allocate X amount of space and anticipate how many flowers or plants we can grow, and then quantify what that potential revenue is, we can add in our projections a new revenue line item to say, okay, we're going to add flowers as an item for sale, and we are expected to make $4,000 on the sale of these 3 types of flowers. We know that it's going to take a month, let's say 1 month for the flowers to grow. We can harvest them over a 3-month period. And in that 3 months, we expect to be at the market for those 12 Saturdays. So we can now then break our goal down further to say, we're going to not only are we making a goal of earning $4,000, but now our goal is to make, let's say, $350 every time we go to the market. And then from there, make a projection of how much we expect to make during those months and throughout that year. So it's taking our vision of creating a new revenue line by growing and selling flowers and breaking it down to a micro level of how much we're going to earn at one market over the time period that we know we're going to be at a market selling produce and other items. So with budgets, we're always told you need to have a budget, you have to have a forecast. And for years, I too was wondering why. Like, why do I need this? It's not fun, it's not exciting. So what is my motivation to do it? What is my purpose for the budget? And throughout the years, the biggest thing that I've learned is everyone's purpose is different. We're not going to create a budget just because we're told we're going to create one, but we're going to figure out what is our purpose in creating that budget. We're also going to ask ourselves, are you aware of your current spending habits? We don't want to set ourselves up for failure, so it's important for us to know, what are we currently spending our money on? That way we can ensure that we can address that as part of our future spending. We want to know, how well do you plan your time and commitments? So in the last example, we decided that we are going to now sell flowers, but do we have the time to be able to do so? Do we have the manpower to do so? Is that realistic for where we currently are in our business? And if so, what does that look like? And then what are your financial goals as a whole? Because the purpose that we're creating this document is so that way we're able to ensure that we meet our goals. So as we spoke about that financial plan that discusses our strategic plan and creating projections, we want to know, what are our goals? That way we can support that through our budget or our forecast. So first thing is our purpose. Why are we doing this? Why are you doing this? What's your interest in doing that? So is it to save money? Maybe you're like, I really want to save for a rainy day. You know, we've been able to sustain, we've survived the harder months, we've had some great months or great years, but now we're looking towards retirement. Or let's say we knew someone that had a huge hiccup in their operations and they were only able to make it because they had some savings. And now we've decided we were ready to save. Is it because of overspending? Maybe you're trying to reduce overspending on problem areas. So prices have gone up, maybe inflation is a problem, and now you're seeking to find other ways to combat an increase in expenses or find new suppliers if that's available to you. I know for me, I'm great about having new ideas, and I always want to see all of my ideas go to fruition. And so sometimes my overspending truly is related to me not stopping and saying, this is a great idea, but it's not relevant to what my goals are for this year. It could be breaking that check to check cycle. So part of the example with that saving money was, having it for a rainy day, but sometimes there's stress going with a check to check cycle of, do we have enough this month? Okay, great. We'll just, we're only worried about this month. We'll worry about next month once we get there. So maybe the budget is to assist us in finding a way to break that check to check cycle. Or it could be to eliminate debt. As we know, going into business, especially in agriculture, it is very easy to accumulate debt in order to make sure that you have the right equipment in order to produce foods or other items that society really needs. So with that, over time, you're like, okay, we have this debt and we'd really like to improve our cash flow, own our items, and eliminate our debt. So the purpose of this forecast being created is to help support that elimination of debt. The next are spending habits, knowing where your money is going. That is really important. We can't set a goal if we can't set a goal that misaligns too much from the current environment. So a great example is, for me, I love to eat out. I love a great fine dining experience. But you know what? So when I can't tell myself that I'm going to go from spending $600 a month on food to spending $200 in food. That is unrealistic, because if I've spent $600 every month for the last 6 months, or even let's say the last 3 years, am I really going to be able to cut that budget by a third? Or even if I wasn't eating out, and that's just the grocery bill, right? Am I realistically able to cut that budget to a third, knowing inflation and the cost of food are rising? Determine if your spending is out of necessity or desire. Sometimes our human behavior can help convince ourselves that something that we really, really want is now a necessity, but it truly is something that could wait. And then lastly, creating a self-reflection of current habits. One of the most difficult parts of this process is being able to look at where the money went and digesting that information. So how often are we sitting and looking at, okay, here is where the money was spent in the last year, the last quarter, or the last month, and what could we have done better, and what decisions can we make from that in order to help sustain or grow our business for the future. And then planning. Planning is a huge part of this forecast. We're trying to project forward what we think we're going to make and what we think we're going to spend. And with that, there's certain things we want to keep in mind. First thing is calendar management. If you know that you have commitments that require you to be away from the farm or away from the business, we can usually assume that there may be a slight interruption in revenue or expenses. So what commitments do you have that could affect that? For me, I tend to attend conferences. So I know if I'm going to a conference, that affects my spending, because now I have to spend for travels. I have to pay for the conference registration. I may or may not have to pay for meals. So that calendar management on those months that I know that I'm traveling, I have to account for maybe a small bump up in travel. There's the balancing of financial obligations and desires. I am not a fan of eliminating all desirable expenses, because if there's no fun in life, are we really going to stick to the budget? So we want to make sure that we have some type of balance between the things that we really need and still having some pleasure associated with that budget. And then also being aware, if there is debt or debt payments, we want to consider that in our budget, because maybe we have to make X amount in order to afford those loan payments. And then simply practicing foresight. I mentioned that we want to look and be able to quantify our business visions. Like, what do you see, and then how do we make that come to life? But in that, we must practice foresight in knowing that our vision may be a 5-year vision and not next year. So having the foresight to understand. In developing your financial plan, there are 4 things that could be related to that. So financial stability, growth management, increased savings or investments. So maybe your financial plan is to help you in obtaining or remaining financially stable. So you're able to sustain the business, you're able to really work in your purpose. But let's say there's still some insecurity associated with having enough funds if there was a rainy day, or if a piece of equipment had to be replaced, not having the funds to be able to do so. Maybe it's for growth management. As business grows, you always hear that the more money you make, the more problems you have, and it's typically true. So as you're growing, it may require you to have to spend more than you can earn in the immediate. So with that, part of the financial plan may be, how can we bridge the gap? We know that we're growing, but in order to have a foundation that supports this larger organization now, there are certain things that we have to do, and we need to come up with a plan to do so. It could be to increase savings. As we, at one point, being on the edge of our seats may be exciting, but we all know it's not sustainable and it is actually very wearing. So with that, we want to increase our savings so that way, if we have a slow month, we can pull. If we have to purchase new equipment, we're able to do so. Or lastly, it's truly to invest back in the business. We know we have aging equipment. We want to buy a new tractor. We need to buy a new copier, whatever it might be. But to do so requires some type of financing, or we want to pay cash and we prefer to figure out how to do so. So what is this is the reason, what is the target for our financial plan? So we have what is our why, what is our purpose in creating it? And then this is also going to support what is the overarching goal for what we're doing. So the final step after having all of these great tips is to create your financial projection. So in creating that, I always say, let's start off extremely simple. And we're going to think, you can itemize it. This is how many products we're going to sell, or this is how much we think we're going to make in a week or a month. And then starting there, this is how much we think we're going to make. For our expenses, we're going to look at what are all of the expenses associated with that. You can always try to find like a sample chart of accounts for your business and seeing if you can use that. So is there an advertising budget? Is there something that we need to put for banking? If your bank charges you a fee every month for just having the account, that should be in our budget as well. What's our contract labor, our supplies, our seeds, our amendments? So really compiling all of the information associated with truly running the business, first direct and indirect expenses. Then we can see how much we think we're going to make, how much it's going to cost us, and always have someone else look at it. So there are resources that can assist you. So the Small Business Development Center typically has locations across the nation that are able to assist you for free. If you have a SCORE mentor, maybe they can help you. If you have a consultant, a consultant, an accountant, but trying to have some base information prior to going and seeking assistance or even for review, because they can only be as helpful as you allow. So there is some homework involved before you're able to truly get the most help out of that individual or that organization. And then we just want to talk about some light bookkeeping. So part of our forecasting that we spoke about was looking back at historical data. What have we done in the past? And we also spoke about holding ourselves accountable, checking in. This is how much we think we were going to spend. This is how much we spent. This is how much we think we're going to earn. And this is how much we actually earned. So when we're thinking about it from a bookkeeping standpoint, how can we use the financials developed to plan for those future endeavors? It requires us to have a bookkeeping system of some type in order to be able to properly create projections that are useful to us. So I just like to put that plug in there, that if you're not currently tracking your revenue and expenses, that is something that is going to be important for you, not only in creating the projections, but also in order for us to compare if we're actually meeting those goals that we set for ourselves. And so with that, if you have any comments, questions, or concerns, please feel free to reach out. We would love to assist you as much as we can, or leave a comment on this video. And you can reach us at trident.org, or please contact Audrey McNair via email at amcnair@trident.org. And I just want to say thank you for your willingness to learn and your commitment to your relationships with your business and your money. If you have any questions, again, please feel free to reach out. Otherwise, I hope this information was helpful. Thank you.